All right, we got to talk. Donald Trump's top economic advisor earlier today came out with really what the economic vision is from the White House. And I gotta say, it really just sounds like what the Trump administration wants to do is copy exactly what Europe did following the great financial crisis. That's what we're going to discuss, how I got to that conclusion, and why I think if Trump really ends up getting what he wants, if the Trump economic vision comes to fruition over the next 4 years, why I really just think the U.S. is going to look like Europe, with a few caveats, certainly a few wrinkles there, but very much in line with what Europe did following the great financial crisis. So coming out today, and you can find the clip itself if you want the context of exactly what was said on CNBC, but effectively, Kevin Hassett came out with two main drive-home points, and that is, above all else, Trump wants to fight inflation by increasing labor supply and lowering aggregate demand. Some people call this a recession, but apparently the vision is a little more nuanced than that. Again, if you watch the clip, knock yourself out. Effectively, what he's trying to say is, look, we're going to get those who could be employable off some sort of government assistance, get them essentially into the unemployed camp, to get them to look to get employment, to become labor, to then apparently drive down demand, and then also lower aggregate demand by cutting government spending. And he's right in the sense that this would technically lower inflation, but this will also lower growth. It will create a very stagnant growth environment. And that's why I think we're really just on the path to Europe. So let's do this. What I'm going to do is I'm going to go over a handful of charts here and just kind of compare what Europe looked like versus what the U.S. looked like in the period following the great financial crisis, and kind of view this through the lens of kind of this post-Keynesian MMT framework that we've developed here on the channel. And let's really start with the most important data set, and that is just going to be what government spending has looked like, again, since effectively the end of the great financial crisis. Throughout all these charts, the U.S. should be the line in red. Europe should be the line in blue. And when you look at total government spending relative to GDP, the U.S. just exploded compared to Europe. I mean, even on a nominal basis, spending in the U.S. relative to Europe was not quite 2-to-1, but we outspent Europe by trillions. And that is just the first big difference. So again, as it stands right now, the Trump administration, they want to close this gap. They want to bring down total government spending, bring down the amount of GDP that is made up by government spending, shrink that, bring that more in line with Europe. The next thing that Kevin Hassett said was to get the unemployment figures to look a little bit closer to what we got in Europe, right? And again, during the post-Great Financial Crisis period, very high unemployment in Europe, whereas because of that government spending, because the U.S. was a little more willing to run a kind of hot economy, because of that, unemployment pushed much lower, much faster, and also because of that, things like wages, even during the period following the Great Financial Crisis in the U.S., were able to climb a lot higher, a lot faster than what we saw over in Europe as well. So a much better employment scenario situation in the U.S. relative to Europe in the post-Great Financial Crisis period. Of course, the other big thing that the Trump administration is big on right now is also getting the balance of trade similar to that of Europe. Of course, Europe, for the most part, in the Great Financial Crisis period, ran something very close to break-even trade deficit, so surplus deficit here and there. Into the end of the 2010s, definitely a bit of a trade surplus. Of course, the U.S., you probably don't even have to look at this chart, we've been running a massive trade deficit, going back really all the way to the 1980s. So again, just another piece that Donald Trump wants to look more like Europe. The other thing, too, that Donald Trump is very much eager to get is lower interest rates. And of course, during the almost entire period of the Great Financial Crisis up until the inflation that we saw in 2022, the ECB had effectively zero rates, and the rate on deposits was actually negative. So again, another thing that Trump is very much trying to do, get interest rates much, much lower, again, very much in line or close to, much more similar to what we saw with Europe, all in the hopes that we end up getting lower CPI. And here's the thing, he is right that if we can achieve all this, if we can get higher unemployment, if we can get lower growth, if we get lower spending, we can in fact achieve lower inflation up into a point. And here's kind of here's the trick, if you will. Again, Europe, blue line, US, red line. For the most part, the US did have higher inflation throughout the period leading up to the COVID pandemic and that post-Great Financial Crisis period. But when a supply chain shock hits, that is when this comes back to bite you in the butt. And that's exactly what we saw with Europe when European inflation far exceeded that of the U.S. And it's a very simple reality that when you hit supply chain issues and you're reliant on importing and the supply chain to be working at all times, you're going to have issues when crap hits the fan like it did in the post COVID era. And this is really the distinguishing factor. Yes, you can achieve, if you just essentially degrowth America, you can achieve lower inflation. That's absolutely something that is very feasible if he's able to achieve all the policy goals that he wants. But if there is a supply chain shock issue, then you're actually going to end up feeling much worse inflation, much worse shortages of goods and that sort of thing being imported in that event because you've grown your economy so slowly during that time frame. And effectively the final kicker here to take a look at is effectively how reliant you are on a kind of credit bubble for growth and what that looks like, or at least endogenous money for growth and what that looks like. And here's the big difference where Europe did have to make up in terms of private debt to GDP. Again, Europe in blue, much higher private debt to GDP ratio. And because of that, overall, when you look at the returns that occurred in the US in stocks versus the returns that occurred in Europe in that time frame, it's night and day. The US just outdid Europe exponentially for the time period in the following the Great Financial Crisis. Once again, Europe in blue, U.S. in red, and the U.S. S&P 500 in red, EZU in blue. So these are both dollar denominated to kind of compare apples to apples. The U.S. far exceeded Europe in almost any financial metric. Obviously, if you could go back to the bottom in 2009, the S&P is absolutely what you would have bought over something like the Eurozone. And this is really just the final thing that I think if you're an investor, you're an active trader, that you need to keep in the back of your mind. What Trump is essentially trying to say, or at least the kind of economic vision is, above all else, we want to defeat inflation, and to do so, we can really just kind of copy the European playbook, and the outcome of the European playbook is not terribly good for stocks. Now, here's the final caveat. Is this possible? Is it possible that the Trump administration can get what it wants in terms of spending, in terms of rates, in terms of trade policy? That remains to be seen. I'm still moderately skeptical. I mean, as it stands right now, there are a lot of political battles in terms of what's happening in the courts for allowing things like DOGE to go through, the various cuts that Trump wants to get in. We're seeing a little bit of a quagmire right now. We will see how that all plays out. But if it does play out, if Trump does get what he wants, I think it's going to be some choppy waters ahead for the U.S. Yes, we will still likely get a credit bubble. That is still kind of my most likely case over the next 2 years. I'm still kind of on that front. But after that, all bets are off. I mean, I think we are still in an environment where Trump is certainly going to want to encourage private investment. And that would definitely be one big difference between at least what the Trump administration is saying right now relative to where Europe has been. The Trump administration is, of course, very much championing getting regulation out of the way for companies to kind of expand. So that'd be one big difference. But that creates a very unstable, a very kind of Minsky-like system to go ahead and build up that credit demand only for that to pop. So again, I think we could go another year or two for kind of a credit bubble again if we end up getting everything in place that Trump wants in terms of the spending cuts, the lower rates, the sort of things that kind of are headwinds to growth. The growth would be supported by the endogenous money cycle, and then eventually the bubble would pop. And so after that, we have this new kind of system in place where the normal automatic stabilizers might not kick in with the immense sort of force that they have in the past, and we could be in a scenario where we get very stagnant, very much the way that Europe was in following the Great Financial Crisis. Again, a lot remains to be seen. One, we just got to see if Trump even is able to stop the spending. And this is one of the new tools that I just published over at appliedmmt.com that the pro members have access to. It updates every single day. It's the Trump spending tracker. Post-Trump is in blue. Pre-Trump is in kind of that orangish gold color. And what this is doing is this is just tracking the same time period in 2024 versus the same time period now since Trump has been in office, since inauguration. So I started on the 21st. We've just started the tracker to see, is spending decreasing in any meaningful way? And so far, Trump has certainly underspent where it is last year, which is in and of itself is a bit of a concern because you need accelerating spending to get accelerating growth out of that spending. So for now, 15 billion shy of where the spending was last year. Although at this point, statistically, probably not terribly significant. We'll want to see a couple months down the line how this is stacking up relative to the year prior. But so far, I wouldn't say Trump has done anything spectacular in terms of cutting spending, but a little bit slower. Nothing major, still a lot of spending, still a lot of time left for this to change again. AppliedMMT.com. If you're an active trader, active investor, head on over there to sign up. We also recently rolled out some other data that tracks taxes, which is really good for understanding kind of where employment is at, where the overall business cycle is at. So a lot of data, a lot of different models all over there for active traders and active investors. But that is all I have for tonight. If you're new here, make sure you get subscribed to that notification bell. Look, things are happening so fast. You don't want to miss any update as we go forward. If you found this video particularly helpful, give it a thumbs up on the way out. So until next time, good trading. We'll talk to you then. Bye-bye.